Welcome all to our third Royal Mary lecture. I'm Tano Santos, the Robert Helbron Professor of Asset Management and Finance at Columbia Business School, and the Faculty Director of the Helbron Center for Graham and Dodd Investing. Thank you very much, all of you, for joining us. As you know, this lecture honors Roger Mary, who is the professor that kept the flame of investing alive between the ages of Ben Graham and David Dodd and Bruce Greenwald when the Helbron Center got going. And for this third lecture, we have decided by popular acclaim, you asked me to do this, to actually have a laid-back conversation with our very own Michael Mabus. So Michael, thank you very much for being here. Michael, for those of you who don't know this, is of course the head of consumer research at Counterpoint Global inside Morgan Stanley. Has had many positions throughout his career. He was the head of global financial strategies at Credit Suisse, the chief investment strategy at Lake Mason Capital Management, and so on and so forth. He is, as many of you know, one of the great intellectuals of the stock market. He's an acclaimed author. Many of you are familiar with his books, The Success Equation, Expectations Investing, which I know is a favorite of many of you. My personal favorite is More Than You Know, which is a book that we're going to discuss a little bit on today. But of course, all these achievements of Michael pale in comparison with the most important role, which is to co-host the Investing Related podcast with me. So we thought to have, to start the year, sort of a laid-back conversation that would mimic the conversations that we have on a regular basis, he and I, and someone thought that it would be a fun idea to have them in front of all of you. So the format is we're going to be talking for 45 minutes or so. Hopefully we'll get to see the questions when they arise, and we will be able to let some of the questions from the audience to also be part and feature in this conversation. So Michael, I want to start with just to warm up a little bit and to get us going, to talk a little bit about, sort of the market. It's been, to say the least, a very interesting market over the last year. You and I have spoken often about what is behind this massive correction. So, we're value investors, so we like talking about specifics, but, it would be unbecoming, I think, not to address what we have seen in global financial markets for the last few months. So why don't we start there? Why don't you tell me what you think is driving this? Where are we in this particular cycle and so on?
Yeah, thank you, Tano. First of all, it's great to be with you. It's interesting that I think you and I had a discussion shortly after COVID.
That's right.
So the spring of 2020. And in reflecting back on that 2.5 years, COVID has created a lot of challenges. It created a lot of challenges for companies, created a lot of challenges for investors, and I think we're still feeling the repercussions of that. So I just put that out there, and first thing to say is that COVID itself made things very difficult about pulling in growth, decelerating growth, how companies allocated capital. So yeah. And that's an important background to bear in mind.
Yes.
Now, the second piece is just thinking about, decomposing what's happened in equity and credit markets for that matter. And clearly the Federal Reserve policy, shifting from concerns about inflation being transitory to more permanent, and I think ultimately the rise in interest rates. Aswath, the motor in New York University, likes to publish every month a market risk premium estimate.
Right.
As you point out, he sort of has normalized expectations for financial performance of the markets and backs into this number. At the beginning of 2022, so January, that number was 5 3/4.
As the
expected return for the market, which, by the way, that's inflation expectations of 2 3/4, about 3% real.
Right.
And as we all know, equity markets historically in the States have earned about 6 to 7% real, so this is half.
Right.
And by the way, consistent story with credit markets and so forth. The most recent reading was last Friday, so basically a week ago, and that number now has touched 10%. So inflation, long-term inflation expectations actually have not changed that much. So now we're bumping above 7% real. So we've had a really marked improvement in expected returns, even as these asset prices have gone down. So that's one interesting aspect. And the second is decomposing, for example, the 10-year. There's sort of two components. One is real and one is nominal. And real rates in 2022 have gone from roughly negative 100 basis points. The last number I saw was positive 140 basis points. And of course, when real rates go up, there's no place to hide. That's why we see it in credit markets as well as equity markets. And for those investors who tend to have equities with implied durations that tend to be longer, there's obviously, it can be quite painful for the short run.
Yes.
Now, that said, we also have to think about the nominal piece. And one of the interesting things as investors is to think about which kinds of companies have pricing power to compensate for the inflation that we see today and obviously longer term. So that's an interesting discussion in and of itself, is not just the real thing you can't really dodge, real rate increase, but the nominal thing. There should be certain types of businesses that have the pricing power that allow them to overcome that.
Yeah, so let's come back to that in a minute. But I like very much this point. And I actually was talking with someone who suggested that you and I should sit to talk for this Royal Mary lecture, who wanted us to go back and discuss our conversation right before COVID got going. Because you and I think, were the last ones to actually sit in the media lab in the whole business group together. To discuss this. And I want to emphasize this point, because I actually think it's quite important. That I think what COVID did for investors, but obviously also for the Federal Reserve, it's a very complicated filtering problem. I mean, you're trying to understand all these signals. You are in a situation you never see, and you're trying to draw inferences from the very noisy signals that you're receiving, and you're trying to make investment decisions, you're trying to make policy decisions, whatever it is. And it's going to be messy, it's going to be volatile. Really different sectors get out of this challenging situation sooner than others, and that is going to further complicate the inferences that you have to determine. Now, we go back to one thing that this increase in the equity premium or the required rate of return on holding securities, the fact that now the equity premium or the required rate of return on stocks, the futures expected returns by the market has gone up to 10%. This number you were quoting. Well, what do we know from theory? Well, it must be linked to an increase in rates or an increase in the premium, right? An increase in the premium reflects markets' attitudes towards risk. Is that what you think is driving that all of a sudden the market is freaking out, or is it the risk-free rate?
Yeah, well, now of course it's both, but this is a fascinating question because this is something we track back to the 1960s. We have the relationship between equity risk premium or market risk premium and risk-free rates. And that relationship was actually pretty stable over time. The equity risk premium was about 80% of the risk-free rate. So it's all roughly ballpark, 4% equity risk premium, 5%. So it's that 0.8 ratio. And then that whole ratio got blown up, especially when we went through the financial crisis, right? And so interestingly, the expected return for equities did not go down that much, to your point, because the 10-year, using that as the 10 years of risk-free note, went down, but equity risk premium expanded, which made, by the way, stocks very attractive relative to credit, so on and so forth. Interestingly now, we're seeing a little bit of a reversal, and that I actually looked at this ratio last week. We're seeing a little bit of that reversal from these sort of extreme levels. So saying this differently, the equity risk premium or market risk premium is 3 or 4 times the risk-free rate. Now we're getting a little bit, we're not at parity, but it's more like a 2 to 1 ratio. So that's a very interesting set of developments. And
this is a word of warning to many of our friends listening, right? That that arguments that exclusively operate through the interest rate are just not quite correct when thinking about it. So you really have to think about what is going on regarding the equity premium.
For sure, absolutely, and that's and again, that in a sense almost had a damping effect. And I think you were helpful as I was thinking through doing the revised version of expectations investing. But interestingly, we did our case study September 2020, so a little over 2 years ago. And I don't know if people remember this, but the 10-year rate was 90 basis points. I think 90, so below 1%. So that, it's just even in 2 years, you see this sort of extraordinary increase in the risk-free rate, which, by the way, this is more normal than 90 basis points.
Right. So can I go back to what you were bringing up before in terms of the composition? When we see these, let's think through the multiple, right? And I think it's a very useful and very clear way of thinking about this. When you see these big movements of the multiple, one component is the discount rate, the other one, of course, this news about future profitability of the market. We've talked about the R, the discount rate movement. What do we think about the G, the rate of growth of earnings and future profitability? Do you have a view on this, or?
We don't have a strong view on this, but I would just say this is why I opened with this idea of COVID being very difficult.
Right.
You know, in other words, there are bold effects and so forth that we're still working through, and then sprinkle in obviously geopolitical events and concerns. And these are all the things that make it very difficult for us to understand. And you're exactly right. I mean, the point of expectations investing is we're going to take essentially as a given some sort of estimate of a discount rate, and we're going to think about the cash flow stream and how those have changed. And again, COVID, I think in the short run, I mean, you just think about very large, very well-managed companies like Target and Walmart that have enormous amounts of information, decades of experience, seasoned executives. I mean, they had a really difficult time managing through this. You can just imagine a younger company. This year, from my course at Columbia, our guest we brought in was some executives from Peloton Interactive.
Oh, wow.
And, and we were talking about competitive advantage specifically for that business. And Peloton was sort of as steady as she goes, doing very nicely. And then COVID happened and, the demand exploded. Well, if you're a management team that's not really seasoned, you don't really know what's going on. It's a very difficult, that upside is actually very difficult to manage through. And of course, there was now the inevitable return. And it's difficult to manage on the other side as well. So I think these presented very big challenges. And so as we know in behavioral economics, one of the biggest concerns, one of the biggest issues is over extrapolation. Of course, our mutual friend or your friend, Nick Barbera, right? So over extrapolation. So I think we have a difficult time not taking a little bit of what we see today, even if we discount it and extrapolating into the future.
The most difficult thing to protect oneself against, I think, is to look at a trend and it's going to keep going.
So that's the thing. So when we talk about G, broadly speaking, that might be something that plays in the mix. Is that COVID threw a lot of curveballs at us, and then we have this over extrapolation.
Can we go back to something that is in your book and that you bring up often, and that I actually think it's something I'm always surprised that people don't use this type of back on the envelope things to get a sense of what the valuation should be. I think I told you this, that during the COVID pandemic, I gave a lecture to a bunch of colleagues and some of the students on exactly how to think about investing during that period, a topic to which I want to return with you. And I was telling them, look, I mean, one simple thing that you can do is go to the valuations pre-COVID, do some sensible assumptions, back out the discount rate, and value securities using the discount rate pre-COVID. And now ask yourself how the evolution of future profitability needs to be to justify this price. And you're going to see that it doesn't make any sense. That you really need to assume this pandemic terrible. I don't want to minimize, what we went through by any stretch of the imagination, the pain it has inflicted on the world. But, we've seen things like this before. We've seen the Spanish flus in other pandemics, and there's light at the end of the tunnel, painful as it may be to be in the tunnel. It's funny that people don't do that simple exercise more often to try to really assess what is a good valuation. That you don't need to be particularly sophisticated, get too cute to actually do these things. You agree with that?
I agree with it 100%. And that's why I always go back to this thing that everything's about expectations, right?
Yeah,
Asset prices are a set of expectations about future financial performance. And the prime task for us as investors is to try to figure out if those expectations are too optimistic, pessimistic, or if they're about right. And you're exactly right. At moments of high uncertainty or extremes, people tend they react. And as a consequence, that can throw that whole set of expectations out of whack.
Right.
Sure. And by the way, it happens both ways. And that's what's in the over extrapolation. I think now, certainly with retrospect, we can look back and say, certainly, for example, in the first quarter of 2021, people got very enthusiastic. By the way, there are other signals, things like the IPO market, the SPAC market. I mean, these are all signals of people being very optimistic and over extrapolating good times. And usually those things come out.
Exactly. So let's talk then in the other direction, which is where we are right now. You and I were discussing right before we came here. And we were talking about, how do we interpret this phenomenal correction? And a lot of people are making this point, the people like the Asnes was making this point as well in a recent AQI insight. It's difficult to justify this correction appealing solely to these discount rate movements. The other is being made through interest rates, but so one of two possibilities. This is what it means. Either you have really awful forecast of future profitability growth for these companies, or wonderful opportunities out there.
Yeah, I don't know the answer, but I think, Tom, this really is a very core to our mission,
Right.
in talking about value investing.
Right, of
because
course.
reminding ourselves that we are buying partial stakes in business.
Right.
And leaving aside the glowing numbers on your screen and rolling up your sleeves and saying, let me understand this business. And by the way, you probably have to think about scenarios of how the world may unfold.
Yeah.
But again, recognition that you're buying a partial stake in a business and really delving into the issues that surround that. And again, this will all play out. I suspect there probably is plenty of babies being thrown out with the bathwater, right? These moves tend to be very correlated, and there's not a lot of discrimination about what is sold and what is not sold. So this actually very likely will be a very interesting time for people who are thinking about buying businesses to really understand what's going on.
Yeah, I couldn't agree. I mean, let's just emphasize this point from the very beginning, that I say this all the time. This is what is really going to pay off, to really have a good process in place and a good solid foundations. But I'll come back, if you don't mind, at the end of the day, because I want to revisit this issue of process, and in particular in light of some of these things that you've been talking and writing about that I want to discuss with you. So can I take a little bit of a historical perspective, if you allow me to do so. So one of the striking things, right, over the last 10, 12 years has been this incredible performance of growth relative to value, and now of course it's turned. I don't think it's related to these movements of the interest rates. Let's leave that aside for a moment. I think it's something deeper that is going on. My fear is that we're going to move along without having a deep understanding of what went on over the last decade. Why did growth do so well? And I think it's an important question. I think we got burned as value investors, at least in the popular narrative. I think people confuse quantitative value investing with what we do. Let's leave it aside. But it is true that at least statistically, something was completely at odds with what we've come to expect after 80 years of stock return data. So what happened, Michael? I mean, what is it? And I know that this is a very difficult question to answer, but quite a bit about it. And we're still struggling with this. We'll come back to current event.
I know. Well, I also don't know the answer to this, but if I were to posit an answer, I think I would turn to the rise of intangible investments and how those things have played through.
Yeah.
I know that you don't want to belabor this point, but I think it is important to distinguish between value investing, which is buying something for less than what it's worth, and the value factor, which is buying things that are statistically cheap. And I don't think
one cannot emphasize
I don't have a problem with value factor.
Spent all my life with my academic colleagues making this distinction.
I have no problem with the value factor, just to be clear, and it may be a proxy for buying things for less than what they're worth, but those are distinct concepts.
Right.
And I think what's happened is the rise of intangibles means that we have businesses now that are expensing their investments. And as a consequence, their earnings and book values may look relatively depressed before you make any sort of adjustments to account for that. So that's one aspect of it I think is important. But second is, and just before I even get into this, just to underscore, this is nothing new under the sun, right? So just to be clear on this. But intangible assets do tend to have slightly different characteristics than tangible assets. Yeah. So intangible assets, we're going to say, are non-physical, right? So think software code and branding and so forth. Tangible will be physical, right? So factories and inventory and so forth. And one of the features of intangible assets, which is a good one, is scalability. And so these are businesses that once you've created, it's usually a high upfront cost, but once you have a new drug is developed or new software has been written, the cost to replicate and distribute tends to be relatively modest. And that was always important. And ideas like network effects have always been important, but they probably take more center stage in the last, maybe even more than 10 years, maybe the last 15, 20 years as a consequence of the internet. So that's sort of the good news. We also see these in the data. As a result, we see that for intangible intensive industries, we see that the mean growth rates are a little faster than what we see for averages. Part of that might just be an age issue, but we see bigger standard deviations. So companies are growing faster than they ever have. Now, that's the good news. The bad news is when you have an intangible based industry or company, there's major obsolescence risk. So things go away very fast as well. And as a consequence, we see the left tail pull out as well. So it's not just good, it's also good and bad. But in aggregate, when you look at it from the stock market point of view, I think that may, I think to some degree, explain this. So part of it's an accounting issue, but part of it is just these things have become more important. Now, all that said, our colleague Jonathan Nee wrote this book called The Platform Delusion, and it's basically application of many of the strategic ideas that Bruce Greenwald popularized, applied to media and internet. And I think it's a very good reality check for people who get overly enthusiastic. So, for example, he cites one paper where they study about 250 companies that aspiring to be platforms. And only about 1 in 6 succeeded, so 5 and 6 did not. So in other words, there's nothing magic here. There's not an easy path to success. But I think those are some of the things that I would probably check off. Last thing I'll say, of course, if you do make intangible adjustments, which is, by the way, a very big area of research, both in academia and among practitioners in the quantitative community, the signals improve, right? So we know that introducing these intangible adjustments is a step in the right direction, understanding value and value creation and some of these even statistical factors.
This is a very important point that the interpretability of these signals improves once you have a good conceptual understanding of how these intangible assets play a role. I mean, I keep telling this to anyone who listens to me, which is a decreasing number of people. But that even if the assumptions are, like the ones you made in your papers, the ones I make in class in the cases, that even if the assumptions are difficult to make, and we just don't know, and we're learning how to do this. Just thinking conceptually clearly about these issues helps you enormously. I can recommend this enough to everyone who has been kind enough to connect today for this webinar. Just think about these things. But you've mentioned so many things, and I want to break them a little bit apart, by the way. And I know that we have a lot to cover, and but I really emphasize how insightful this point you made at the very beginning is that. What happens with these new companies is that once that investment is made and they've succeeded in creating the network, the marginal cost drops to zero. And this has very profound implications for everything, particularly for industry dynamics, because now an entrant is going to face a company that can expand effectively at will, because the marginal cost of providing an additional subscription account is very low. It's whatever you're paying the cloud provider for the additional space in infrastructure that you're using to power that business. And in that sense, kind of the elasticity of responses to threats to entry has increased dramatically. And if you have a core competency, you have the second point that you were bringing up, that you have these superstar companies that all of a sudden it's very difficult to dislodge these companies, right? So that's by the way, can we talk a little bit about that there's so many things that come to mind. So let me add this thing of the obsolescence risk, which I think is very important. That it's something that I don't know how to think about, because for that you really need to have a good group of engineers next to you to explain to you this. That the internet has been going on now for almost a quarter century, right? So we are beginning to have some of those companies that are faced with the obsolescence of the tech stack with which they power their business. So we haven't seen a lot of manifestations of that yet, but I certainly think this is a risk that some of these companies are facing.
Well, we do already have a little graveyard. We could say AOL or Yahoo and Nokia and BlackBerry.
That's right.
Okay, so
don't you think those were like early generation?
Maybe, but that's part of the story.
Right, exactly.
They're not what they were.
Yeah, definitely.
So,
definitely. Definitely, that's not what they were. Definitely. But granted that point. So, I think that's kind of a risk that we're going to be facing, and that's going to be playing along. I want to talk about the platform aspect of this. I want to get your sense of this, on this competition dynamics in the platform economy and the valuation, which is a point that I've been making in some venues, and that many of the things you may have come up in conversation you and I had, and I'm, you know, like, keen of stealing ideas. So when you have a platform, the thing to understand about a platform is that when it is created, it's very difficult to launch, point number one. But the second thing is that you can use that platform to sell something else, okay? So that's what makes it so difficult for an entrant. You know, I'm not surprised that about that statistic you were quoting just a moment ago, that, I have a platform like a messaging service, right? Maybe I can put an overlay a payment platform. I already have the network created.
Right.
So that complicates competition dynamics greatly as well, in my opinion. Having said all this, the issue of barriers to entry and competitive advantage, if you look at the ROIC of many of these companies, if you look at market shares, if you look at markets, just astonishing, what we've seen over the last 30 years. Can you talk a little bit about that? And
Yeah, and by the way, just to,
you put a paper right now.
I did,
Yeah.
I'm happy to talk about that. I mean, I just to emphasize something you said, I mean, if you think about demand side economies of scale and supply side economies of scale, right? When you do establish a platform that is successful, by definition, network effects says that the value of the good or service increases the more people use that good or service, which increases willingness to pay. So automatically, if we don't raise prices, we increase consumer surplus, which in a form is a competitive advantage and a barrier to entry as well. So you get those on the demand side. On the supply side, you get traditional old school supply side, cost per unit going down. So if it's working, you're getting both sides of that. And then, the cherry on the top of the ice cream sundae is optionality, as you pointed out. So in other words, if you see something, you have the people in place, the networks in place, the infrastructure in place, then can you add on things and exercise options on top?
An existing network.
Now, let's go back and talk about this idea of markups. And just to be really clear, in economics, markup is the idea of when price is above marginal cost, right? It's an indication typically of what's called market power. And so as investors, we seek this, of course, right? This is good. But of course, from a consumer's point of view, the lower the price, the more consumer surplus there is. So by definition, if we're raising price above marginal cost, some consumers are going to be hurt. There'll be some economic profit for the firms. There may be continued consumer surplus, but it might be quite what it is. So the basic story in academia is that if you look at markups in the United States from 1955 to now, you have this pattern where they're basically flat from 1955 to 1980, and then we've been sort of hockey sticking up through today. And this, of course, has gotten people very, up in arms about this because this is issues around antitrust and concentration and so on. So that's the basic narrative. And by the way, there are two other side stories that are really interesting. One is, if you examine the differences between industries, those relationships have actually been very stable, even as this has been going on. The action is within industries. So it's been within each industry, a couple companies distancing themselves from everybody else, which is itself very interesting. And we see that very specifically when we look at the time series in quintiles. So the bottom 4 quintiles, well, bottom 3 for sure, not much going on. A slightly positive slope, but nothing that interesting. 4th quintile, okay, but the 5th quintiles were all action, right? So it's these so-called superstar firms. Yeah. So that's the basic narrative, and I think to some degree it could be the point of concern or alarm. But now the interesting thing is,
this one about this, this issue, that when you see this as well in labor earnings.
Yeah.
So if you happen to work in a company that is a superstar company, you do incredibly well in terms of labor outcomes. If you are in the 30 pointer,
exactly.
So
it all fits, right?
Yeah.
Now, what's interesting is it goes back to our question on intangibles. What if we introduce intangibles? And so the classic way to think about these markups, very simplistically, there's a elasticity input elasticity functions, usually a theta, and then you just take sales divided by cost of goods sold, right? And the simplest is 0.85 times sales of cost, that's your markup. Well, economists have come along and said, wait a second, are we really capturing input cost? Is COGS the only input cost that's important to us? Sales being our output. And what if we dip into SG&A and suggest that some percentage of SG&A is deemed to be an input? Because there are devils in the details about how to do this,
right.
but directionally that does feel right. When you introduce this using some standard methods that some of the academics use, and it's a paper by Peters and Taylor, is sort of the standard way to do this. All of a sudden, you introduce those into the markups. A few things happen. One is the aggregate level of markups go down. It's still gently rising, but it's much less dramatic. It wouldn't probably wouldn't freak people out as much. And then interestingly, when you look at this between industry and within industry effect, basically goes away. And the top quintile in our time series, it goes up a little bit, much less so. So the superstar firms don't appear to be superstars anymore. And the argument then, the intuition would be something like these firms that are so-called superstar firms are precisely the firms invested in most intangibles. And that those intangibles may be going back and conferring the advantages, specifically disadvantages that we've been talking about. Now, there's one other thing I'll mention that's interesting. That there are a lot of limitations to concentration data, just to be clear, number of companies,
like market share, things like that,
percentiles and so forth. But there's one interesting stat I found that an academic calculated the hazard rate of a C4. So C4 just measures the market share. It says if you're in the top 4 of an industry market share, what's the hazard rate? What's the probability you can get kicked out? That you're going to drop out of that top 4 and someone will take your spot. And that hazard rate since 2000 is half of what it was in the prior 20 years. So the strong are staying strong, and the weak are having a more difficult time cracking the top.
That's right. That coincides with that intuition that there's something happening at the very top of these companies, that is making them. And as an investor, of course, it has paid off to have those kind of fortress companies in your portfolio because they seem to be incredibly resilient to whatever may happen. But
and that shows up in our concentration data for markets, right?
Exactly.
Top 5 or 10 or 20 companies.
I can ask you then, so many of us have been preaching the desert about regulatory risk for a long time, that eventually, the attitude of the regulator is going to change. We've seen this historically, by the way. It's not that we haven't seen this happening before, even when companies were even more powerful than they are today. Very similar political environment, like the populist environment at the end of the 19th century, beginning of the 20th century. The progressive era was an interventionist era, very willing to work with the Sherman Act to break monopolies and break up firms. How do you think about that? How do you incorporate it into your?
Yeah, I think it's.
And by the way, before that, those of you who want to ask questions, you can ask them in the Q&A, and someone will fit them magically to my iPad. So if you see me, you're welcome to start asking questions in the Q&A, and they will fit them to me, and I will select them as appropriate.
So, Tom, this is a very important issue on regulation, and we've been trying to do a little bit of work on that to sketch it out. And by the way, I'm going to just say, first of all, not being an expert in this area, it seems extraordinarily complex to me, right? And as you point out, the first thing just to observe is you go back, like you said, basically a century, 125 years,
yes,
roughly.
Yeah.
There have been ebbs and flows in both public opinion about big companies and political opinion about big companies. And sometimes big companies are embraced because they deliver economies of scale and that's good for everybody else. And other times they're considered to be villains and so on and so forth. So the ebb and flow. And so we're now in a case where it appears, at least politically, maybe not.
We're going in a broader direction.
Public opinion may not be, is a little bit more muted. In fact, interestingly, many of the large technology companies that are specifically targeted by things like the FTC or DOJ are precisely the companies that are most popular. So consumers don't seem to be so concerned about this.
The only one exception to that being Meta.
Meta is the one
exception. Polling always comes.
And I think Meta is worth, it's a very interesting conversation just to have, because one of the big things that a lot of our numbers don't capture, and this goes back, I was saying this to Al Rappaport, my collaborator on expectations investing the other day, that Milton Friedman wrote a very famous essay about, the job of companies to deliver profits, within rules and so forth in the 1970s. And I said, I mostly agree with what Friedman said, but I think if there's one thing that he didn't speak to, or a blind spot, is a discussion about externalities, and in particular negative externalities. I think today, again, the concept's been around for a long time. Today, we're more aware of perhaps negative externalities than we were before. And so as we think about these technology companies, and I think Meta is a good example, we need to think about, are there negative externalities? Can we codify them? I think those things.
Can I say one thing about this, by the way? I think that you are spot on these. I think, what is interesting about this kind of platform economy, this kind of technology society that we're building, there are a lot of, obviously, because of bias to entry, they're simply linked to the rise of services, which are locally provided. So I think that point is well understood. I think there are a lot of bias to entry here and there that are very difficult to uncover because they are not big companies that are every day on the front page of the Wall Street Journal. So the risk seems concentrated, right, on the big tech, so, companies like Meta or Google or Amazon, they're going to be very much, if you look at, Brussels would be very active in its competition policy. They seem to be going after the big tech companies. I'm sure they, do so also because, they have competitors for whatever business we are in Europe, But effectively, it seems to me that there are a lot of good opportunities, even in an activist space by the regulator, because my sense is that they're going to go after some companies and not after others on account of the limited resources that they have to implement antitrust regulation.
Yeah, I don't disagree with any of that. And I'll just say, though, I just having spent some time thinking about markups as one of these indicators and spending time on concentration as one of the sort of signals to investigate whether a deal should go through, for example. That research seems like it's all over the place. In other words, if you want, if you say to me, find 3 qualified economists to say concentration's up, I can line them up for you. If you want me to find 3 economists who are qualified to say concentration is not a big deal, I can find those 3 for you. So in the court of law, I don't know how those things ultimately will be carried out. The other thing is interesting is unintended consequences. I think that the FTC, there have been a couple of cases already where they maybe are trying to reach a little further than they should be trying to reach, and we'll see how those are treated by the courts. But it's a very much, so in other words, I think at a very minimum, for these big tech companies to make acquisitions as they have over the last 10 or 15 years will be much more challenging. I think they all understand.
Not only that, I think it's going to affect how they behave in certain situations. I think they're going to display a particular self-restraint when they go after not direct competitors, that's perfectly valid, but moving in adjacent areas, they're going to be very tentative. That's my sense. So all of a sudden, if you're looking, I think for investors looking at particular companies that are the threat potentially from big tech, what we may see going forward is these big tech companies, broadly defined, it's about the usual names, being much more, I don't know how to say it, conservative. Measured, because they're worried if I do this, the FTC or the Department of Justice and the Trust Division is going to want me.
I agree with that. Yeah.
So I want to change a little bit, so I don't want to run out of time without talking about something that when many of the friends of the center in particular learned that you were coming, they wanted me to discuss with you a little bit. And I don't know when this was, by the way, because there's, read everything you produce, and so that I miss something, okay? But I think you were talking in one interview about issues of process, implementation, execution. So I want to have a conversation in the last 15, 20 minutes of our conversation about, let's assume we've taken care of how to think about investing opportunities. How do we, the craft of asset management, the craft of being an investor, the craft of running a good shop that can make good decisions and that has, the process in place to avoid the pitfalls of behavior and psychological biases that you also were versed in. So can we talk a little bit about, I don't know how to ask that question.
No, it's great. No, I think you've given enough of a lead to get into this. And it's obviously really important and very dear to my heart. And I think to some degree, probably the courses that you and I both teach are related to trying to develop that process. But let me first say this, that as an active investor, it's very important to think about why you think you can do better than a benchmark or beat the market, right? What is your source of edge? And let's just take 2 extremes. Let's say Jim Simon's a Renaissance Technologies, right? Brings in lots of super smart people, lots of computers, trades very frequently. So his process, or the process of Renaissance Technology, has to align with that objective. That's how they're going to win, right? And by the way, if they can make money on 52 or 53% of the trades, they're going to do fabulously well. Then on our other string, we think about one of our famous, alumnus, Warren Buffett, who reportedly sits around his office all day and reads, and then every now and then something comes in and he makes very big, lumpy investment decisions, right? So he's thinking all the time, but he's not acting all the time. His investment process may be very different than Jim Simon's. They both can be successful. So the first thing I would just say is reverse engineer how you think or why you think you can do well in this game, and then make sure everything in your process is consistent, congruent, and consistent with it. And I'll just say one of the things that I see a lot is people say one thing and do something different. And that's really important. There was a great, I think this may have been when it came up, but there was a letter from Beth Klarman to his shareholders where he said, you know, it's our aspiration that if you came and lifted the roof off of our building at Bauhaus and watched everybody doing their jobs, they'd be doing exactly what you would expect them to do, given what we told you we do.
Yeah.
Right. So again, it's congruence. Okay, so that's the first thing I'll just say, that there is no answer, not one size fits all for the process. Now, the second thing is we wrote a piece earlier this year where we delved into this in great detail, and there are really three different parts to it. The first is, what kinds of people do we want to bring on board? Who do we want to hire? And I was I've been taken by two threads of literature on this. The first is the work by Phil Tellock at the University of Pennsylvania on the so-called super forecasters.
Oh, yeah.
And you know the story, there was a forecasting
And a
tournament.
great book, by the way, to recommend to everyone. If you can, you're going to read a
Yeah,
book.
super forecasting is great. You're going to get the story. But there, you know, the U.S. intelligence community decided to sponsor the tournament. A bunch of universities put together teams. Phil's team, more than just Phil, but a bunch of people. They put it together a team, and again, they found that they were doing well. But when they really delved into it, this is thousands of people participating. They found that 2% were so-called super forecasters. In the book, there's one little page where Phil gives the characteristics of these super forecasters, and it's everything I want in an investor, right? You're open-minded, you're humble in the sense not that you don't think much of yourself, but you recognize the world is complex, right? Probabilistic, you're numerate, you're a good updater, you're hardworking. It's just like everything on that list is like check, check, check. So the question is, can we find people with as many of those characteristics as possible? Maybe, you know, you want them to be from diverse backgrounds. And the second thread of research is by a guy named Keith Danovich, a developmental psychologist emeritus at the University of Toronto. He wrote a book in 2009 called What Intelligence Tests Miss. And the claim he makes, it's very provocative, is that there's this thing called IQ, measures something real, more of it tends to be better than less of it, right? But he distinguishes that from what he calls RQ, rationality quotient, which is essentially the ability to make good decisions. And, you know, by the way, we all know people like this, people that go through school and they're really smart, but they don't really do so well in life. And other people are just not, they're not geniuses, but they tend to make really good decisions. So Danovich really wanted to understand this. So he developed with some colleagues something he calls comprehensive assessment of rational thinking. It's called the CART. So he wrote a book about that in 2017. And that book goes through all the sections essentially of this. It's been administered from an academic point of view, but not broadly administered CART test, testing for rationality for these different sections. You put those two things together, Tano, and I think you have a really nice backdrop for thinking about the kinds of people who are likely to be successful investors personality-wise. Now, the next thing I will say is, you have a son who's a beautifully accomplished musician, even as a young man. I'm sure he practices hard. He probably has a teacher who works with him to make sure that he's directing his practice in such a way that he improves his skills. Here's the question I would pose. In investment organizations, what is our practice?
Yes.
What is our training? So, you know, your son is going to perform, but he's going to allocate some time to practicing to get better so that his performances are better. We want to perform with results for our shareholders. The question is, how do we think about practice? And this is, I think, is a fascinating question. It gets into things like skill transfer. But the problem with investing is you can spend all day just ingesting information, all day, right? So how do we do that? So that's the other thing I'll just say is thinking about process is if you've got your process defined and what we're trying to do and you have the right people in their seats, how do we think about practice? Okay, that's the first piece. The second big piece is organizational. And that is where you mentioned sort of managing or mitigating biases. What we know is embedded in organizations, the organization can improve your decision-making, can deteriorate decision-making, or be kind of a neutral factor in it. So how does your organization stand to improve the quality of your decisions? And this is really how we work in teams. And I would just say the biggest mistake that organizations make is a failure to surface various alternatives. We decide on something and we close in on a decision without really thinking about all
exploring the entire state space of what might happen.
And we don't want to diddle, you know, we don't want to twirl our thumbs, but we also want to, and by the way, there's a new book coming out in the first of the year called How Big Things Get Done by Ben Fluvia and Dan Gardner. Dan actually co-wrote Super Forecasting with Phil, and How Big Things. And so Bent is the world's expert on large projects. He's got a database of 16,000. So think about maybe Olympics or building an opera house or subway system. It's a big project. And by the way, they're disasters. But he's got this line in here which I just love. He says, think slow, act fast. Think slow, act fast, right? Which is, you're going to think about all the potential outcomes, but when it's time to act, you're going to be prepared, right? So I think that's a really key component. So what are the mechanisms to do that? It's things like appealing to base rates. It's things like doing pre-mortems. It's things like red teaming, so you make sure you have assigned devil's advocates. By the way, can I tell you what I'm doing this weekend? You might appreciate this.
When you were in Madrid, you just told me you were in Madrid.
I was not in Madrid this weekend, unfortunately.
Yeah.
I would have had a good time if I was there this weekend, but I was there. So this is interesting. The Catholic Church introduced the devil's advocate for canonization of saints, and I'm going to get the year wrong, but it was like in the 1500s, something like that. And then in the subsequent, 400 years, there were very few, like less than one saint per year canonized. So it was a really high bar.
But the devil's advocate was doing its job.
And then essentially the devil's advocates was stripped of his or her responsibilities in the early 1980s, and we've had hundreds and hundreds of saints canonized in the last 25 years.
Catholic, I can.
Exactly. So it's an interesting thing that when you lower your standards, more things happen.
The portfolio of saints.
The portfolio of saints has gotten much more. So then the third point, which is really the one I want to spend most time on, is talking about how do we give ourselves feedback? And in the investment industry, it's very difficult, right? Because if I buy a stock and it goes down, was I wrong? It's hard to say. Or if I bought something and my thinking was sloppy, my rationale was poor, and it goes up, was I right? And so the question is, how do we create structured ways to give ourselves timely and accurate feedback, right? So your son's teacher is giving him timely and accurate feedback on what he's doing, and so he can correct mistakes and so forth. How do we do this in the investment world? So what I would argue is, if you're going to buy or sell a stock, you typically believe something that you don't think is priced in, right? So you think you have some sort of edge, or there's a thesis about something that's going to happen that's not priced in. Well, if that's the case, you should be able to articulate that thesis and then actually write it down.
Exactly.
And that lends itself, so the image I want people to have is, a road to a realization of this thesis. So this company's going to grow faster, or allocate capital more judiciously, or be bought out, or whatever it is, sort of this path. And as you go down this path, you should pass signposts. And for these signposts, I want people to be very split about writing them down. And there are three things you really want to keep score. One is an outcome that we can agree upon. So revenues will be X, they'll sell this many units. So something we can agree upon after the fact. Second, within a time period. So by the end of the year, by the end of 2023, whatever it is. And third is with a probability. So we're not saying zeros and ones, we're saying with a probability. So if you have outcome we can agree upon within a time period with a probability, that allows us to keep so-called prior scores. These are the scoring, a very simple scoring system. And the reason this is important, well, first of all, just asking you to do that will be a valuable exercise.
Of course,
it's going to unfortunate thing. That said, in almost every domain where people maintain prior scores, there's evidence that they become better calibrated. They can get better at this process. So to me, this is one of the ways, instead of saying stock goes up or down, which is ultimately what we care about, clear, we're going to break it into subcomponents. And if we're right about the subcomponents, we should have some confidence we'll be right about the overall thesis. And this gives us feedback along the way. And by the way, if we really miss something badly, it's a waypoint. We pull off the road and we say, okay, stop. Here's what we believe. Doesn't seem to be happening. Should we quit? Should we reverse course?
Exactly. I think this point is so important, right? That I'm very gratified to even say this, because I tell the students, you always write things down, because it's very easy to fall prey of the self-attribution bias, that everything that happens is because the good things that happen to you is because you're awesome, intelligent, and the bad things is because the gods are against me, and the bad luck happened. A common friend at Kent, Daniel, I asked him once, he was in a distinguished financial service organization that were doing incredibly well, and I asked him, what is the secret sauce? That's what we know we're very smart, obviously. But in addition, since we're very good at asking ourselves when we do well, whether we're doing well for the reasons that we think we're doing well.
That's right.
And you will be surprised the amount of times that we just got lucky. We got the argument entirely wrong. So, and he said, most people don't adjust in the presence of good outcomes.
That's right.
People adjust in the presence of bad outcomes, particularly because the market forces you to adjust.
Exactly.
But it's in the presence of good outcomes where you distinguish the good organization from the bad organization. So can you mentioned something in passing that I think we should discuss for the benefit of our audience, which is you have to have a thesis, you have to be able to articulate it. You have to also know where the other side of the transaction is coming from, right? Marty Whitman says that this is what distinguishes great fund investors from not so good investors, which is, you have a thesis, but you haven't asked yourself, how come you're the only one who knows? And you always have to ask, and that is also a particular discipline you have to impose on yourself. Not only that I see an angle on this company, but why is it that I'm the only one seeing this? What is that allowed me to? And writing those things down, it's really having a coherence. It doesn't need to be, War and Peace or,
That's right.
Keep it simple, keep it to the point. It's one page. As I always tell my student, double-sided, both sides, you're done. And then you store it 10 years later when you look at the position.
In time, I'll just say we wrote a piece and it was called literally "Who's on the Other Side," and we developed. I thought it was a clever acronym, but it was called the BATE model, which is behavioral, analytical, informational, and technical. And so the question is,
why do these acronyms?
The acronym, this is a good one. But anyway, so the question is, if I believe I know something that the other person doesn't,
right,
or they're what is it? Do I think they're over extrapolating and I understand regression? Is it that I'm analyzing, we have the same information, but I have a better way to analyze it? Do I have better information, which happens from time to time, but hard? And then is someone buying or selling for reasons that are not fundamentals? There's technical, they have to sell. This is sort of the Joel Greenblatt spin-off argument, right? People just sell for reasons that are not fundamentals. So the degree which you're actually overt about writing down why you think efficiency is being constrained, I think is also very helpful exercise. Yeah. And again, if you think that you're a better analyst or you have better information, that's a lot of hubris, right? So you have to be careful about. But at the end of the day, all pricing mistakes are probably behavioral, but this is, I think, a nice little taxonomy for us.
So we have a great question, which is, I'm curious about your answer. Mine is, I don't think it's that interesting, but I have an interesting question from the audience. How do you structure your day, and what sources you read regularly from?
Yeah. So first of all, my job responsibilities has three components to it. One would be working with our team on investment process. I'll say candidly, since COVID, it's been more difficult because we're less together than we used to be.
Right.
And so that's a challenge. But that is one part of it is, and we published a piece this morning on return on invested capital.
Yeah.
Before that goes out, we sit down with the whole team, go through it and talk about it, right? So that's everywhere from sort of formal things to much more informal. The second is just doing research. And then the third part is external things. So my typical day is, depending on what's going on, but a lot of it is ultimately, which is great, a lot of time allocated to research. What do I read? I mean, I'm probably similar to most people. The things I read every day are the Wall Street Journal, the Financial Times, the Washington Post, New York Times, and this is something, those are the big ones probably. I read The Economist. I read, the thing that I get is probably a little not usual is Nature magazine. And so I read about science developments and so forth. And then I read a lot of, I end up for the research reports too, reading a lot of academic research. So that's one of the benefits of my job is what I'm trying to do is keep on top of the academic literature and try to glean from that the ideas that are useful for us as practitioners. And not all it is, and some of it is really interesting. So that I have and so the way I think about my day is I call it input output, which is I'm trying to learn and then I'm trying to write it down or codify it to share with others. And I'll just say, by the way, I don't know if you have the view as well, but I found the most inspirational teachers I've had throughout my life were the best learners. Because they're impassioned about the topic, they're up to date on what's going on, and they're excited about it. And so that's what I strive for, is making sure that and so I'll give you an example. Today we're now working on a big piece on capital allocation. We've heard about this before. I've written about it in a few years, and I'm just doing this big sweep of the academic literature to see what's out there that's new and improved on mergers and acquisitions, and catbacks, and R&D, and buyback, and dividends.
So I like that. I mean, I read, I wake up in the morning, I read the Wall Street Journal, the New York Times, trying to keep up with what is going on, the interesting news about that company you didn't know about, those that immediately put in that slide for the students. It's a lot of fun. I know you do this as well. I, read the crazy book that you'll read at a particular point in time. So, it can be, now I'm reading about economic history, ancient economic history, trying to understand. I'm just always surprised. I can never emphasize this enough, how many lessons economic history has. And, it is true, it doesn't repeat itself, but boy, does it rhyme. It does. It really does rhyme. So that's a business history, a lot of business history. Why is it that particular sectors, particular industries evolved the way they did? So I read all of that. I find it absolutely fascinating. But then I go on with tangents, and I know you do this as well. So I've become obsessed with, I've been reading a lot lately about the literature on the issues on covering interest rate parity. This funny thing that is happening in global financial markets, that arbitrage relations don't seem to be working anymore, and trying to understand why it is the case in the global financial crisis. So I go down that rabbit hole, and in the process, there's something you keep your craft as a researcher alive.
That's right.
That you want to get to the bottom, and I very much would emphasize everyone to do that. That's your passion, that's your career. Go deep.
Absolutely.
Adopt the mind of a scholar, and don't be satisfied with have answers, but try to go deeply. It's a way of staying sharp. I don't know.
I love that.
And then of course, the many things that has professionally need to do in order to keep a pace with everything.
Committee meetings.
Yeah, I had like two of those. Two of those.
I'll say I also want to admit that I spend a decent amount of time on Twitter, and I don't follow very many people, but the people I follow I really like, and I actually get a lot of good stuff on Twitter as well. So
it's funny because I don't Twitter, but I'm a consumer, and then like 2 or 3 other people. I tweet my topics. So
yeah,
I get interested in a particular topic. There's some wonderful people tweeting about what is going on in the UK.
Absolutely.
And then you follow and get a lot of these wonderful insights of people who are in the market and give you a so that's very distracting.
To get you distracted. I'm sure for me, it's actually a pleasant experience. I know a lot of people complain that
Let's go back a little bit to what you were saying before in relation to good practices inside firms, which is this idea of knowledge management. If I can leave with one recommendation to everyone, is really think about how you're going to structure the process of knowledge acquisition and storage, having your teams, really have to devote some time to think about that. Now we're running a little bit over time. And so, but there's one question that I want to ask you. It's a little bit of a challenging question, but I think it's only fair that we ask it. It's going to be a good way to finish our conversation in this Royal Mary lecture. Over the last 5 years, this audience member asks, 84% underperformed the S&P. If you go 10 years, that increases to 19%. What is the argument for allocating to active managers?
Yeah, by the way, those data have been, as long as for the first time they were examined, that's always been true, right? So there's actually nothing new, and if anything, it's gotten more difficult than it has.
Yeah.
There are a couple key issues. One is that it's important to understand not just what percent of people outperform, but how much they outperform by. So that's an important distinction. So are there tails that are interesting? But at the end of the day, the key question, I wrote this book about luck and skill. This distills down to that topic, which is, are there things I can do as an investor allocating capital to identify a priority potential skill? And so that to me is the rich area that I want to look at. And so if I'm going to give money to an active manager, I'd want to make sure that they're doing something different than the benchmark. And we've seen obviously the last 20 or 30 years a gravitation toward benchmark hugging, which is not a bad way to keep your job and not a good way to.
Yeah, exactly.
We have seen a drift lower in fees, which is probably a healthy thing. But there's this work by, I'm sure we talked about by Jonathan Burke and Richard Green, Burke and Green model.
Oh yeah, of course, yes.
And
that work,
and Jules von Binsbergen has picked up where Green left off, and that model basically says what they examine is I don't know if there's that term for it, it's basically it's gross returns less benchmark returns, it's risk adjusted, times AUM. So in a sense, it translates, it's almost like a residual, profit figure. And it turns out that that figure tends to be much more persistent than, for example, alpha is. So, I mean, I think you have to go in with eyes wide open. That's one thing. And then the other thing I'll just say is that active managers, there are certain parts of the market where active management skills and specialization can give you advantage, right?
Yeah.
And so one of the ways I always like to think about this is where is their dispersion? And I got this, by the way, originally from David Swenson in one of his lectures. So he said basically, if there's very limited dispersion in performance of investment managers, well, little dispersion will index, right? Because we want exposure to that beta. By contrast, if there's large dispersion, we'll try to find the people we think have high chance of being skillful and we'll allocate to them. So part of this is even in public markets, say, well, geez, even in public markets, certain investors skew to certain types of things. Look at the dispersion by even sectors or industries. And if you are interested in a particular manager, see if he or she's operating in basically high dispersion sectors. So that would be some things I would just kick off. But by the way, we talk about this. We have a very long discussion about this in class, and we show all the numbers going back over long periods of time. And basically the probability of any active manager outperforming in a particular year is about 40%.
Yeah.
About a 15% standard deviation. So that's the distribution.
I think this is important to returns are very, very noisy.
They're very
noisy. It's very difficult to invert skill out of return, even over a long period of time. I mean, alphas are averages, and even 5 years of data is not a lot.
But Tana, I'll just say this, as we sort of wind down, I mean, it's interesting today. I mean, if I just give a very rough characterization of markets, and this is an imperfect picture, but essentially mean return of 10% over time, S&P 500 is called, with a 20% standard deviation, right? So 2/3 of my observations are plus 30 minus 10, right? 95% are plus 50 minus 30, right? So when you start to think about the world that way, that this is the distribution in which I'm operating, years like this, they're not pleasant by any stretch of the imagination, but they're also not to be unexpected over some periods of time. And by the way, when you have really good years, same thing. You should say, like, this is unusually good. Count our lucky stars, but we should recognize that regression toward the mean says that outcomes that are far from average will be followed by outcomes with expected values closer to the average. And that's a very important thing just to keep in mind.
And in looking for those managers, I think going back to what you were saying before, right? I mean, really look for that manager that you think has first a coherent investment philosophy to the one that you have, and most importantly, has that process. And look at those managers that are clients, So I really think that in that sense, there's nothing new under the sun.
That's right.
We've gone 7 minutes of the time. Michael, by the way, we're going to be back with a podcast very soon.
Yeah.
So you're going to hear more from us, whether you like it or not. The Michael Mabus and Danovich show will get on the road again. But thank you very much for this wonderful Royal Mary lecture, and I'll see you.
Thank you, tomorrow. It was a real pleasure. Thanks everybody for joining us.
Thank you so much, everyone. Thank you. It's someone. So this was, there's so many topics to discuss, right? This is just hard to discuss. I like very much, I think it's only this thing of this distinguished investor telling me about how they actually think about the team. And, just like you, that's one of the dimensions of what I'm telling people in the team. Avoid you.
Too much IQ.
Yeah. Because it's correlated with overconfidence.
Definitely so. I'll tell you one interesting side story. I was at the Santa Fe Institute, and we were doing a session on